A common investing principle is to make your money work for you. But did you know this applies to your crypto holdings too? Instead of letting your crypto sit idle, yield farming, a $9.74 billion industry, can help you put those assets to work and earn returns. But before you dive in, it's crucial to understand the strategies and risks involved. Remember, this video is for educational purposes only. Always do your own research or consult a financial advisor before making any financial decisions. In this video, we're breaking down the essentials of yield farming, what it is, how it works, and the key concepts you need to know to navigate this exciting world. Whether you're just starting out or looking to deepen your knowledge, stay tuned for a clear and concise guide to mastering the basics of yield farming. Hi everyone, welcome to Crypto Coast News, your gateway to crypto mastery. In yield farming, investors can lend, borrow, stake, or provide liquidity to decentralized finance platforms, also known as DeFi. DeFi makes it possible for anyone with an internet connection to access financial services that traditional banks offer. Before we dive deeper, let's go over some key concepts you need to understand yield farming better. A liquidity pool is a collection of crypto assets held in a smart contract that facilitates transactions on a decentralized exchange, or a DEX. For example, when someone uses a DEX to exchange Ethereum for Bitcoin, the Ethereum tokens go into the pool and the Bitcoin tokens come out of the pool. A liquidity provider supplies the Bitcoin and Ethereum tokens to the liquidity pool, and they're rewarded with a portion of the trading fees, often measured in annual percentage yield, or APY. APY represents the percentage return on an investment over a year, accounting for the effects of compounding. In yield farming, it's not uncommon to see APYs of 100% or more, though this reflects the inherent risk in this investment approach. Achieving such returns usually involves a carefully planned strategy, often including switching between providing liquidity, lending, and exploring different DEXs offering various returns. Liquidity pools are fundamental to decentralized exchanges. They enable traders to swap tokens directly without intermediaries, making trades faster and more efficient. Now, let's explore some of the different yield farming strategies that investors use. Lending is one of the strategies often explored in the world of yield farming, where individuals can potentially generate passive income by participating in decentralized finance platforms. Let's take a closer look at how this process works and some of the factors to consider. In decentralized finance, or DeFi, lending platforms like Aave or Compound allow users to deposit the crypto assets, which can then be borrowed by others. These platforms act as intermediaries, connecting lenders with borrowers, who typically provide collateral, often in another cryptocurrency, to secure their loans. Interest is earned on the deposited assets, and the rates can vary depending on the demand for the specific asset and the platform. For instance, when there's high demand for borrowing a particular cryptocurrency, interest rates might be higher. While lending is often seen as a stable way to earn returns, it's important to be aware of the risks involved. These include potential smart contract risks and the possibility that a borrower's collateral might drop in value. DeFi platforms usually have mechanisms in place to manage these risks, such as liquidating collateral if its value falls significantly. Before we go through the next strategy, if you're interested in building your own cash-flowing DeFi business, check out the completely free course by Crypto Labs Research linked below. It covers everything from business models to risk mitigation, and even showcases real portfolios generating daily income of hundreds of dollars. Next, we will look at liquidity providing. Liquidity providing is often discussed as a popular strategy within yield farming because it allows participants to potentially earn passive income by contributing crypto assets to a pool. Here's how it works. The strategy involves supplying crypto assets to a liquidity pool on a decentralized exchange, or DEX, such as Uniswap. In simple terms, by contributing to the pool, you help ensure that the DEX has enough assets for users to trade. In return, liquidity providers may receive a portion of the trading fees that the DEX charges its users. In some cases, platforms might offer additional incentives, such as platform-specific tokens. These tokens can be traded or used to provide further liquidity in other pools, depending on the platform structure. The rewards earned for providing liquidity are typically proportional to the contribution made to the pool. A liquidity pool usually consists of two different tokens, and when adding liquidity, the value of each asset deposited must be equal at the time of the deposit. For example, if one Ether is worth 100 USDC, a participant would provide both 1 Ether and 100 USDC to maintain the balance in the pool. The pool's ratio doesn't always remain fixed like 1 to 100. Instead, it can change based on market conditions and trading activity. However, when initially adding liquidity, the value of the contribution should match the current market price of the two assets. To illustrate how the fees work with simple numbers, if the total value of the pool is $1,000 and the value of the contribution is $10, this would represent approximately 1% of the total pool value. As a result, the contributor might receive 1% of the trading fees generated by that pool. As the pool's value changes due to trading activity, the contributor's share of the pool remains consistent, though the value of the assets may fluctuate. Liquidity providing has the potential to be lucrative, but it's important to be aware of the associated risks, such as impermanent loss, which we'll discuss shortly. Now that we've covered liquidity providing and lending, let's move on to another key strategy, staking. Staking is another strategy commonly explored in the world of yield farming. It involves participating in the security and operations of certain blockchain networks, allowing participants to potentially earn rewards by supporting the network. Proof of stake, or POS, blockchains enable participants to validate transactions based on the number of tokens they have staked. This method contrasts with the more widely known proof of work, or POW system, where validators, or miners, are selected based on their computational power, making POS a more energy-efficient alternative. In POS blockchains like Cardano, the more tokens staked by a participant, the higher their chances of being selected to validate transactions. Successful validation typically results in rewards, which are distributed in the form of additional tokens. The rewards earned from staking are usually paid out in the network's native cryptocurrency. These rewards are often a percentage of the staked amount and can vary depending on factors such as the total amount staked on the network, the duration of staking, and the network's overall performance. While staking has the potential to generate a steady stream of rewards, it's important to be aware of the associated risks. One significant risk is the lock-up period, during which staked tokens are inaccessible and cannot be sold or transferred. If the market value of staked tokens declines during this period, participants could face losses due to the inability to sell before further price drops. Additionally, there's the risk of network failure or slashing, where a portion of staked tokens could be forfeited if the network penalizes validators for improper behavior or technical issues. Staking is often viewed as an attractive strategy for those interested in contributing to the security of blockchain networks while potentially earning rewards. However, understanding the risks and the specifics of the lockup period is crucial for anyone considering participation in staking activities. Compounding is a strategy often discussed in yield farming for its potential to maximize returns. It involves reinvesting the earnings generated from yield farming back into the same or different yield farming opportunities, with the goal of generating additional returns. Essentially, compounding can be seen as generating yields on top of previously earned yields. This process creates a cycle where your earnings continuously contribute to generating more income, which can exponentially increase total returns over time. When rewards are earned from yield farming, whether in the form of interest, fees, or additional tokens, participants generally have two options. They can either withdraw those rewards and realise their profits, or they can reinvest them into the farming pool or a similar platform. Reinvesting can increase the amount of capital working, potentially leading to higher future rewards. There are some key considerations for compounding. Frequency of compounding. In the crypto community, some users discuss the potential benefits of frequent compounding, such as daily or weekly, which may enhance returns compared to monthly or yearly compounding. However, this approach might come with high transaction costs, particularly on platforms with significant gas fees. Auto-compounding services. Certain yield farming platforms offer auto-compounding features where rewards are automatically reinvested. This can be a convenient option for maintaining consistent reinvestment without manual efforts. Diversifying reinvestments. Another concept often explored is diversifying reinvestments. Instead of reinvesting rewards into the same pool, some participants choose to spread their reinvestments across different pools of strategies, potentially spreading risk and taking advantage of varying yield opportunities. Monitor and adjust. Given the dynamic nature of the crypto market, some users monitor and adjust their compounding strategies regularly. Market conditions, platform reliability, and token values can change rapidly, so staying informed can help in making timely adjustments. While compounding has the potential to dramatically enhance returns, it's essential to remember that it also increases exposure to market risks. If the value of the underlying asset drops, or if the platform experiences security issues, the compounded investment could face significant losses. It's important to consider the balance between risk and reward carefully. Now that we've explored some of the key strategies in yield farming, liquidity providing, lending, staking and compounding, it's important to understand that while these strategies can offer significant rewards, they also come with their own set of risks. Yield farming isn't just about chasing high returns. It's about being aware of the potential pitfalls and understanding how to navigate them effectively. Cryptocurrency markets are known for their volatility, and this can significantly impact yield farming returns. The value of stakes or pooled assets can fluctuate rapidly, affecting the overall value of holdings. For instance, if the market experiences a sharp downturn, the value of assets could decrease quickly, which might reduce the returns earned or even lead to losses. Another key risk to consider is impermanent loss, which specifically affects liquidity providers. Impermanent loss occurs when the price of the tokens deposited into a liquidity pool changes relative to each other. Let's consider an example. Imagine depositing 1 Ether and 1000 USDC into a liquidity pool when 1 Ether is worth $1,000. If the price of Ether increases to 2000, the pool will automatically rebalance, leaving less Ether and more USDC when withdrawing. In this scenario, although the total value of assets may still be higher than the initial deposit, more profit might have been made by simply holding on to the Ether and the USDC outside the pool. This difference is referred to as impermanent loss, and it's a factor to be aware of when providing liquidity, especially in volatile markets. Understanding the risks involved in yield farming starts with education. It's important to be informed about the platforms and protocols you engage with. This involves learning how smart contracts work, the security measures in place, and the potential vulnerabilities of the assets being used. Many in the crypto community emphasize the importance of staying up to date with audits, security reports, and community discussions to gain a better understanding of the landscape. Another concept often discussed in the crypto space is diversification. Diversification refers to spreading assets across different strategies or platforms. By not concentrating all assets in a single pool or staking them on one platform, the potential impact of a specific issue, such as a smart contracts bug or a market downturn affecting one particular asset, can be reduced. This approach can help manage risk by distributing it across multiple areas. In summary, while yield farming can be a lucrative strategy, it's not without risks. Impermanent loss, market volatility, and the challenges of managing investments are all factors that could impact returns. The key to successful yield farming is to stay informed and be prepared. It's important to conduct thorough research, understand the risks, and manage investments carefully. By approaching these strategies with awareness and caution, you can make more confident decisions and better protect your assets. Understanding the strategies and concepts covered in this video is crucial for anyone interested in yield farming, as it can help you navigate the complexities of the DeFi space more confidently. Remember, yield farming is an evolving and complex area of cryptocurrency. The more you learn, the better equipped you'll be to make informed decisions. If you're serious about mastering yield farming and staying ahead in the fast evolving world of crypto, make sure to subscribe to this channel. We have a lot of videos on this topic coming down the track that you don't want to miss. By subscribing, you'll gain access to educational content, insightful guides, and the newest developments in DeFi. Join our community of learners and let's explore the exciting possibilities of crypto together. Thanks for watching, and I'll see you in the next video.